based on what you've heard from the president-elect so far when it comes to cabinet picks, initial tariff threats, can you quantify the risk of stagflation over the next 4 years? Are we talking about 20% odds? Are we talking about 70% odds?
Well, some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion, too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort. So if you look at this list of policies and others, all of them have the impact that over time, inflation will be higher, growth is going to be lower. That's a standard analysis of what's going to be the implication of this policy. So we have to worry about the world in which overall over the next few years, inflation is going to be gradually higher, economic growth could be lower. And therefore, you have to find a hedge against a world in which bond yields on the long side may be much higher than 4%. They might go towards 6, 7, even 8% in a scenario where inflation goes from 2 through 3, 4, 5. So that's the kind of concerns I have and the kind of tail risk. Inflation, debasement of fiat currency, potential de-dollarization, debts become unsustainable, climate change, geopolitical risks that fragment the world and lead to less growth and more inflation. Those are the kind of things we start to have to worry about and hedge against.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you will not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis. Some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for lots of reasons about cryptocurrencies and Bitcoin because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
It's really interesting to hear those comments because, I mean, as Eric pointed out, some of the things you're saying really resonate with a lot of the crypto community, but it sounds like that volatility is just keeping you away here. But, I mean, the argument can be made that you take a look at gold, and it's not exactly a reliable hedge of inflation. I mean, it goes back and forth over the past 4 years. I know we're close to record highs right now, but when it comes to a stable store of value, are you sure that you found it in gold?
Well, gold has the benefit that has a variety of hedging characteristics. Usually, when inflation is higher, it does well. When there is a risk of debasement of fiat currency, it does well. In a world in which central banks are moving away from the dollar asset because of the dollarization, because we've weaponized the dollar for national security and foreign policy reasons, gold goes higher. Part of the reason why gold has gone higher 40% this year is because central banks of our rival are diversifying away. When there's a financial crisis and your money is not even safe in a bank, gold does well. So it's not a perfect asset, can go up and down. It's one element of a portfolio where you're hedging against a variety of tail risks. And from that point of view, is a better store of value than cryptocurrencies that are based on nothing. They're vaporware.